Hello and greetings to everybody. This video clipping will be useful for all commerce students, students pursuing BCom, any management course like BMS, BBA, uh, BFM, BBI, all students who have this chapter capital budgeting in your subject financial management. This small clipping will be useful for your studies. Well, in this clipping, we will give a brief introduction of what is capital budgeting and what are the different methods. Students interested to learn financial management as a curriculum, may please contact me. My contact number is 99670 which is mentioned in my page as well. We can plan to go ahead with the online coaching schedule. Let us speak about what is capital budgeting. Here, we specifically mean long-term investments. Let's say that a company wants to invest in a machine and this machine is going to cost 5,50,000 rupees. Here, this is a long-term investment. So first of all, the problem here is you have to select between machine A, machine B, machine C, selecting the right machine in which the investment has to be made. So let's say we have got project A, project B, project C, selecting the right project. Now, to select the right machine in which the investment has to be made, to select the right project in which the investment has to be made, there are different capital budgeting methods available. We can broadly classify the methods into traditional methods and those methods which take into consideration time value of money. The traditional methods do not consider time value of money. We have payback period and ARR, that is average rate of return. Payback period and average rate of return does not take time value of money into consideration. Both fall inside traditional methods. Now, those methods in which time value of money is considered, these includes discounted payback period, net present value NPV, profitability index PI, and internal rate of return IRR. We will discuss one problem in which we will learn the concept of net present value, which takes into consideration time value of money. Let us in this example assume that we need to invest in a machine and the investment amount is rupees 5,50,000. Now, we are given in this problem that if we invest 5,50,000 rupees today in a machine, then this machine is going to have a life of 5 years. So in the coming 5 years, in the first year, this machine is going to provide a cash flow after tax. CFAT is cash flow after tax. So by utilizing this particular machine, we will generate a cash flow after tax of rupees 1 lakh 1 year down the line. In the second year, we will generate CFAT cash flow after tax of rupees 1 lakh 50. In the third year, by using this machine, we will generate 2 lakh rupees CFAT. In the fourth year, we will generate 1,50,000 rupees as cash flow after tax. And in the fifth year, we will generate 1,25,000 rupees CFAT, cash flow after tax, by utilizing this particular machine. Let's assume that this machine has a life of 5 years. Now, looking at the problem as such, the investment amount is 5,50,000. So today, the amount that we will be investing is 5,50,000 rupees. And what we'll be earning in the first year, second, third, fourth, and fifth are these amounts which are cash flow after tax. So if you look at it, 1.5, 1.53 lakhs, 2 plus 1, another 3, so 6, 7.25 lakhs is our total cash flow after tax. So looking at the problem, it looks like we invest 5,50,000 rupees today in the machine, and in the next 5 years, total we are going to generate 7,25,000 rupees cash flow after tax. So it definitely looks like the investment is worthwhile. It definitely looks like it is worth investing in the machine because we invest only 5 lakh 50. However, we are going to get 7 lakh 25,000 rupees in the next 5 years. So you recover the amount that you have invested. This is what the picture looks like. But now let us enter into the problem and use this net present value method to find, is it really worthwhile to invest in this particular machine? Mind well, to find net present value, we need to consider time value of money. This 1 lakh rupees we are going to get 1 year down the line. This 1 lakh 50,000 rupees we are going to get 2 years down the line. And so this 2 lakh, 1 lakh 50 and 1 lakh 25 we are going to receive 3 years, 4 years and 5 years down the line. So all these are future cash flows. You are going to make the investment today and all these amounts are future cash flows. Now we need to find, if we are going to receive 1 lakh rupees 1 year down the line, what is today's value? So today's value is PVFCI, present value of future cash inflow. Future cash inflow is 1 lakh, जो एक साल के बाद मिलने वाला है, उसका आज का वैल्यू कितना है? What is the current day value? So 2 years down the line, you're going to receive 1 lakh 50,000 rupees. What is the present day value? 5 years down the line, you're going to receive 1 lakh 25,000 rupees. What is the current day value? For this, in financial management, we learn a topic called as concepts in valuation. Let's put it in simple for those who can understand. 500 rupees is what we have today. The value of 500 rupees today, let's say after 3 years, will it remain the same 500? So if I have 500 rupees today, let's assume that it is equivalent to me having 610 rupees 2 years down the line or 3 years down the line. So what I can purchase with 500 today is the same that I will purchase after 2 years at 610. So let's put it in the reverse manner. 2 years down the line is 610, current day value is 500. Which means whenever we know the future value and we need to find the present value, whenever we know the future value and we need to find the present value, we use discount factor. In this problem, to find the present value of future cash inflow, I have considered discount factor at the rate of 10%. The formula to find discount factor is 1 upon 1 plus r raised to n, which we will learn further once we start with the curriculum as a course. So when we apply 10% discount factor, our discount factors happens to be 0.909, 826, 751, 683 and 0.621 for the first 5 years. Which means when I multiply 1 lakh into 0.909, I get 90,900 rupees. The meaning is, if I am going to receive 1 lakh 1 year down the line, ये 1 लाख जो 1 साल के बाद मिलेगा, उसका आज का value is 90,900. The amount 1 lakh 50 which I am going to receive 2 years down the line, this 1 lakh 50's present day value is 1 lakh 23,900. You multiply 2 lakh into 0.751, you will get 150,200. So this 2 lakh which you will receive 3 years down the line will have a present day value of 1,50,200. And so we multiply 1,25,000 into 0.621, 1,50,000 into 0.683. Now why should we find the present value of future cash inflow? The investment that we are making is today. The outlay happens today. Therefore, if you have to compare today's outflow and today's inflow. So today's outflow is 5,50,000 rupees which we are spending to buy this machine. Although all these values are future cash inflows, we have converted the future cash inflow into present value. Which means when I sum up 90,900 plus 123,900 plus 150,200 plus 102,450 plus 77,625, we get total present value of future cash inflow. PVFCI is present value of future cash inflow. The total present value is 5,45,000 545,075. Now, what you're going to receive is 545,075. Present value of future cash inflow is 545,075. And what is our investment? 550. Which means in today's terms, if I speak, we spend 550. But in today's terms, we get only 545. So what we are doing is, whatever we are getting in future, we are converting into present day value. So now if you look at this, when you apply the discount factor at 10%, we find that our investment is 5,50,000 rupees. But what we actually receive is only 545,075. Which means present value of future cash inflow is less than outflow. To find net present value NPV, we will do present value of future cash inflow minus outflow. So 545,075 minus 550 will give us minus 4925, which means the net present value is negative. The learning is that initially we thought that this particular investment is going to be worthwhile because we are spending 5,50,000 but total cash flow after taxes 725. But actually when you apply time value of money, although you invest 550 and you are getting 725 in total, but actually what you are getting is not 725. Actually what you get is only 545 considering a 10% discount factor. Which means this investment is not worthwhile. It is not worth to make this particular investment. Just to learn, if I have to change this 5,50,000 and make it 5 lakhs. Now, our net present value would become 45,075, which means, yes, it is now worth to make the investment. So, future value, all these are future values. We convert it into present value. The present value total is 5,45,000. And what we are spending today, outlay, is 5 lakhs. So, the net present value is 45,075, positive. Always to select a particular machine or a project, the NPV has to be positive. And whenever you have to compare multiple machines A, B, C and select the right machines, we will always look at the investment, we will always look at the machine which will give highest NPV. A project or a machine or an investment with negative NPV should never be selected. Similarly, we have all these methods in which whenever we compare different investment alternatives, for average rate of return, we will always select the investment in which the average rate is highest, the rate of return is highest. For payback period, we will consider that machine, we will consider that project, that investment in which the payback period is least. Similarly, for discounted payback period, we will consider that machine, we will consider that project in which the discounted payback period is least. We will always select a project in which the net present value is highest. So friends, in this video, we can arrive at the conclusion that capital budgeting is for long-term investments decisions. You need to take a right call as to which machine has to be selected to make the investment, which projects have to be selected to make the investment, for which we make use of different capital budgeting techniques, which includes traditional and methods which consider time value of money. Thus, this is a brief of capital budgeting. To learn the different methods, ARR, payback period, discounted payback period, NPV, profitability index, IRR, to learn all these methods in detail, to learn the chapter of capital budgeting in detail, and to cover financial management, all topics in financial management in details, do contact me. My number is 9967029869. This number is mentioned in my page as well. Do contact me. We are open for online learning. We will have online coaching depending upon your curriculum, whichever state you are in, whichever university you are studying. We will we will have a copy of the syllabus that you are following and we will amend the learning accordingly. You can contact me in this number and we can definitely go ahead for the online coaching. For those who like the video and those who feel that this particular video is useful, Do forward the link to your contacts, to your friends. For all you know, the purpose is to spread out, the learning to everybody, the reach the learning to everybody. Thank you very much. Bye bye.